Morning. Got a lot to talk about this morning. 8:25 Friday. I think we're clear of sort of any 4th of July hangover. Will be last Friday happened to be a pretty slow day, generally speaking. We'll see what this Friday is about. Got a little bit of a rally in bonds this morning that you're waking up to. Ginny's roll today, and not a ton of data that really moves the market. A lot of housing stuff, permits, prices, noteworthy certainly, and then Michigan sentiment at 10. Generally speaking, bonds down about 3 basis points in yield. MBS maybe up 5-6 ticks. There's some distortion on the screen because of the roll. It'll be very interesting to see how we absorb the roll here over the next couple of days. We were getting a little bit wide yesterday. We got some housing data post sign off. General NAHB housing market last month printed 35, revised to 36. We expected 35, came in at 34. So net neutral. Pending home sales revised down 0.3, 3.8 to 3.5, and we expected a negative 0.5 and came in at negative 5.4. In a vacuum, not really a rate mover, but a big enough miss that you maybe scratch your head on that a little bit. And then here at 8:30, we've got housing starts, import prices, building permits. Business inventories yesterday came in on the screws. So what's going on with the screen today? It's a little bit of an interesting case study in the markets, and we talked about this, probably 4 months ago, and maybe even before that in this context. Outside of this, I've talked about this on the Market Minute and other things I've done historically, right? Well, let me digress for a second. One of the reasons why I always talk in time frames, right? What's good for stocks or bonds today might not be good for stocks or bonds tomorrow. And so in the context of how many times have we seen the Fed cut rates, but rates go up, at least in the near term, or the Fed raise rates, but rates come down, at least in the near term, is the perception that when the Fed cuts rates and therefore is more accommodative, that will eventually lead to inflation. That's sort of the point of cutting rates, right? Is what's implied is that you're below your 2% mandate. We've got to cut rates to get people to spend money so that inflation goes up and then we're at 2%. I mean, that's the insanity of this hamster wheel we're on, right? And maybe not literally, but at 1.8 we're cutting rates, at 2.2 we're hiking rates. What the heck? The difference, honestly, is imperceptible as far as I'm concerned. But I get it, over 350 million people, maybe it's not. We have a pretty strong flight to quality this morning. So before I get to that, from a data standpoint overnight, not a heck of a lot. The inflation data continues globally to come in better than expected for bonds. So that would sort of be the data story overnight. But in the markets, we're kind of having a bit of a global sell-off, might be a big word, but a global sell-off in stocks. The Nikkei down 4%. Most European stocks were down between 0.5% and 1%. Here onshore, Dow futures indicating down about 60 basis points, S&P down about a point, NASDAQ, and we'll talk about that, really leading the charge, down almost 2%, 550 odd points. and the Russell down about a point. VIX up almost 10%. And, you're saying, gosh, how could rates be rallying a little bit when crude and Brent are up 2%? And that's what we're talking about here is, almost how far is too far. Precious metals are off and the dollar mixed, but generally stronger versus other currencies. So what's going on overnight is that there has been pressure on semiconductor stocks, really, questioning AI, right? And I guess to really simplify things, are we getting ahead of ourselves? Listen, as far as I'm concerned, no, not getting ahead of ourselves. And this sometimes is the lunacy, the on again, off again mentality of the markets. So part of this stock sell-off is that. Part of it is the intensification of the conflict in the Middle East. And, to come full circle to the point that I was originally trying to make is back in the past, right? Even though war was theoretically long-term good for the economy because we're manufacturing stuff, we're less of a manufacturing economy nowadays. That's why we tend to trade the wars or conflicts, whatever you want to call it, escalations differently. In a historical context with what's been going on in Iran, we should have seen over the last 2, 3, 4, 5 months a flight to quality. And one would think at a minimum that flight to quality might offset any increases we saw in gas prices. This conflict is certainly unique in that who we are at odds with controls about 20% of the world's supply of the thing that tends to most drive inflation. So it complicates things. So what we're seeing this morning is somewhat of a flight to quality based on Iran, based on this slowdown or this mental slowdown in the contemplation of the impact of AI and therefore semiconductor stocks and so on and so forth. So that's what we're seeing right now. And, we are sitting at 453 on 10s, right back to, if I were to pull a 5-day, we're actually even slightly better than the 454 that we hit. What was that? On the 15th, is that Wednesday? So if you guessed wrong, if you didn't sort of heed the warning, you're back. So my prescription for today, because I don't love trading geopolitical nonsense. 1, 2, I am not convinced that this AI trade is right. And here's the but 3, I keep saying that this market, as far as I'm concerned, is moving in the direction of more accommodative interest rates. That doesn't matter on July closings. So personally, I think you'd be crazy to not lock the dip today. Certainly 6.25 and up. 6.5s are finally catching a little bit of a bid. Maybe 6s continue to be strong like bull, and 5.5s are back in the territory of where while we are certainly off 715 intraday, and but we are absorbing this roll, so carry could translate to rate sheets. I think personally, if you're anywhere near Wednesday's rate sheets on 5 3/4 to 6 1/8, and it's a July closing, you're just simply crazy not to lock. I don't know that there's enough tangible reason for this rally in the context of how we've traded the current conditions, I'll call it, over the last week or so. I think if I step outside of that, right, I'm more bullish on rates. I'm bearish on rates because I think that this rally is sort of headline driven, and those headlines might be misleading, if you will. I think that if I'd feel better had we not retraced some of the gains we made earlier in the week. I'd feel like this was more sustainable. As I sort of, I think it was reiterated, but maybe as I established, I forget if it was the second time that I talked about this, my longer term lock float bias is certainly more float than it is lock relative to, say, last Friday. Frank, what Manhattan report are you talking about? So that's where we are. Next week, while I wait for Frank to tell me what he's talking about on the Manhattan report, next week, Monday, light day. Let's see if this calendar filled up. Tuesday, ADP. Thursday, jobless claims. Friday, S&P. I don't think these calendars have filled up yet. So, yeah, there you have it. For those of you that continue to take on float risk, I think today's your day. How have we traded it? Well, what I could say to you is we're somewhat long down in coupon, and we're long 6.5s. And depending on what kind of levels we can get from the market, we're going to cover some of that position and take some of those profits. But as I've been indicating, we're flat to short 6s because that coupon it continues to provide some pretty strong value. So as always, thanks for joining live. Thanks for watching on replay. Went to go see The Odyssey last night. Pretty solid movie. 3 hours or whatever it was. It was a 5:50 movie. I got home maybe a little after 9. So, okay. Thanks, Frank. So it was pretty short for a 3-hour movie. Remembered reading that book back in college. So yeah, I'd recommend it. If you like that sort of stuff, I kind of like history. So, have a great weekend. Remember, bulls and bears make money, pigs get slaughtered.